Okay, welcome back. Happy Easter. So this will be a shorter segment. It's about the different foreign exchange regimes. Basically, you might remember every country has to choose what kind of foreign exchange rate regime it has. Do they want to fix it so it never changes? Do they want to let it do as the market tells it? Or do they want to do something else in between? And so the basic combos here I got, and I'll talk about each one quickly, is flexible or floating, managed float, or sometimes they call it dirty float, and then fixed rate. I'll also talk a little bit about others, right? So any country can decide, and you might remember the United States has, over the years, it's gone from a fixed rate, gold standard, and then today it's more of a flexible, sometimes dirty, float range. So let's talk about those, right? So first one, maybe I'll erase here, is, let's see if I can find my eraser, right? Let's talk about flexible, right? It's probably the easiest one. It's the one, actually, without us saying it, that you've already sort of studied. But it's the one where the government or the central bank of a country doesn't do anything. Just let it be, let supply and demand do its thing, and we'll accept whatever price the market gives us. So what that's going to be here, let me draw this baby up, is I'll make a timeline graph. This will help me compare over time, right? It's not supply and demand, it's just over time. It could be weeks, months, years, right, over time. And this will be whatever the exchange rate is. So if we're talking about a flexible exchange rate, what's going on with these, right? Remember how that works? It's flexible, floating, like a cork on the seas. It's just as supply curve or demand curves moves, gets bigger, gets smaller, like you've been doing on problem set 2 and coming up exam 2, is that the exchange rate is allowed every day, every hour, even every minute, make a move, right? And it's actually, especially like coronavirus and like news and as we read it every hour, it moves a lot. So zigzag, zigzag. And that's currently what the US dollar is doing, right? Now, the other one over here, I guess, I'll go to this side, right? And then we'll do it in the middle, is what we could call totally a fixed rate. Fixed rate. Or sometimes I hear pegged. It's pegged to some other currency. And again, this is not supply and demand or whatever quantity. It's over time, months, years, as you might say. And here's the price of a currency. And, right, we haven't been together in a while, but oftentimes I talk about the Chinese currency. Historically, for a few decades, has been generally a fixed rate, but in the last couple of years, they've let it wiggle a bit. But a totally fixed rate would be one where it's not doing any crazy zigzag. It's just, here's the price of a currency, right, whatever it is. And every day, every month, even for years, it's the same. Doesn't go up, doesn't go down, it's the same. And it's like this. Maybe, as China has, they've let their currency, appreciate a little bit, so maybe it goes like this, but generally it's like flat. And we can talk about, what's good, what's bad about this. Traders, companies selling things, they like this because, they don't have to worry about that. They don't have to hedge, as you might remember. All right, I purposely left a space in between here, as we can call, if that's flexible or float, we can do the managed one, which is a combo. Right? This is sometimes called managed or managed float or dirty float. Again, this is time. This is managed or dirty float. Dirty meaning like not pure, managed or dirty float. Right? Dirty float. Alright, so you get the gist. It's generally going to be let supply and demand do its thing, but once in a while the government or central bank comes in and says, whoa, this is getting out of hand. So for example, this is the exchange rate going on, and it's every day up and down, every hour, every minute, but every few months, something's happening, and it's like, wow, our currency is getting really expensive, right? What can happen is the government or central bank will come in, and they will make a big intervention, and in this case, sell this currency, and then boom, it goes down, and then hands off again. Supply and demand, open the paper every day, it's just doing its own thing. They might have another one, like an intervention, where they go up to here, and then hands off. Right? So here and here are two interventions. And really, what is an intervention? It's the bank coming in to buy a lot of a currency and sell the other, or vice versa. So when you want the price of something to go down, what do? You sell that currency. If you want it to go up, central bank comes in and buy that currency. So managed float, dirty float, that's kind of the story. And this is this one. Actually, if you might think about this, right, is that this one and this one really are the same. And I remember I mentioned in class before, but what's going on here is that the wiggles, right, that this one is allowing are much smaller, right? If you hold them way down in there, is actually this exchange rate, the Chinese currency, is going up and down, up and down, up and down. But the Central Bank of China only lets it go up and down a tiny bit, like up, down, like 0.0002 or something, you know, up and then down, and it's right in there. So really, that's what's going on. All right, so those are the three there. Let me do just quick other ones, and then I'll make a different, you know, what do you call it, video. Keep these things a little more modular, shorter. So if that's managed, if that's fixed, and that's flexible, there are some interesting hybrids or sort of in-between choices that I'll put up on here. And you might remember I studied the Russian ruble in the late 80s and 90s. Russia was a really interesting place to study foreign exchange because they were trying all these regimes and they had problems. And so my dissertation was on trying to forecast the ruble even as they changed the regime. So those are three. There's another one we can call, which, let me just draw it, and we can call it like a corridor. Right? You might remember this one. We talked a little bit about 360, but this one, sometimes what happens is that you might remember purchasing power parity, right? Is that whatever country has more inflation, its prices are rising faster, that country is going to have a depreciating currency over time, right? It's kind of a long-run forecasting model, but whichever country has more inflation. So, a place like Russia or Venezuela today, that's the one, everybody knows in Venezuela that their currency is going to be depreciating, right? And so if they want to have a fixed regime, it's not going to work. They're not going to be able to keep it fixed, right? So what they might do is they might have a corridor and say, well, we're going to announce it, or maybe we won't announce it explicitly, but people quickly figure this out, is maybe they'll have an invisible or visible that they announce ceiling and floor. It's kind of like, all right, our policy is we're going to look at this ceiling and the floor, and whatever happens to our currency, we're never going to let it go above this ceiling or below this floor. So it gives it some wiggle room. So as long as, market forces are doing their own thing, zigzag all you want, Mr. Currency, it's just fine, right? But as soon as you start to fall down to here, and it wants to go below, what do they have to do? Remember, we got to raise up the price of this one to keep it in the corridor. So here an intervention would come in and they would buy that currency. So if you buy a lot of something, it's more in demand, the price of it tends to go up. So they push it up with a big intervention. And then just let it be, move along like this. And if it were to start to drift too expensive or too valuable, then what you want to bring the value of this currency down is you sell, dump a lot of it on the market and buy the other currency. Right? So this one is generally called just a strict corridor, like a hallway, kind of keep it in the hallway, don't let it go outside of the hallway. That actually is not perfect for like Venezuela, right? Because, it allows some movement with inflation, but still over time we know it's going to generally go down, right? So another type of corridor would be an adjusting corridor, right? A hybrid corridor. corridor is, what could they do over time again? Is say, okay, we know there's going to be a depreciation, it's going to go down, but we'll let it kind of do its thing. So we'll announce a floor and a ceiling, a corridor, but it's not flat, it's controlled fall. We're going to let the currency fall, but we're going to control it, not too craziness, right? And, if they do this, what's the rule? It's again, central bank hands off unless the market forces start to push the currency above or below. So it can wiggle as much as it wants, but as soon as it gets, too low, buy, keep it up, and then let it do its thing. And as soon as it gets too high, it wants to cross the upper ceiling, they got to sell, and keep it in there, right? And generally this can actually help with inflation over time, like it did in Russia in about 93 or so. You can imagine what else could they do is, let's say things do get better in inflation. It's, here it's dropping at a pretty fast depreciation. Well, maybe things get a little better and inflation in this country, or hopefully like Venezuela, their prices start to not fall so, increase so much. Maybe they can change their corridor to something like this, and then it becomes closer to just a straight fixed corridor. So it's something like this. All right, so those are probably 5 different regimes. Generally speaking, the United States has a flexible exchange rate. We got one that the dollar goes up and down and up and down, and only once in a while does our government step in. Okay, so I'll stop there and make a separate segment. So here we go.